Hi, and thank you for joining us this week for ConnectStrat's Ask a Strategic Coach webinar. I apologize because I didn't record the very beginning, so I'm doing a little quick re-record to set the stage. I captured everything that our guest speaker had to share and all the way through the end, but I missed the opening. So I just want to introduce ourselves. We are ConnectStrat, and I want to introduce the coaches. I'm Jamison West. I'm a strategic coach and EOS implementer with ConnectStrat. Also joining us from the ConnectStrat team today are Brett Jaffe, Jason Knight, and Fred Gengin, all also ConnectStrat strategic coaches, all EOS implementers, and with various other accolades, life and legacy planning, strategic planning, DISC, Colby certifications, and the like. We do a lot of work. If you'd like to talk with us, please ConnectStrat.com. Today, our guest speaker is Trevor Shakiba. You will, by watching this webinar, get a tremendous amount of information around kind of markets, where we're at, how to invest, how to build wealth. He was previously with Ameriprise, broke out on his own, and is doing his own thing now, building some investments. So please take a look, have a listen, and feel free to contact. I will share his contact information at the end of the webinar. Thanks much.
Because there are fears that COVID is going to have a second wave. And remember, the market hates uncertainty more than anything, even bad news, because it cannot price that in. And so that's how you begin to see opportunities. So let me do a quick recap. This, again, going back to the craziness of it, just to give you some perspective, we experienced the quickest correction ever. And a correction is defined by a 10% pullback or more in I believe it was 6 days. So it's 6 days, starting February 12th, the Dow was at 29,500. Everything's bouncing along. 6 days later, we're down 10%. Approximately 30 or 35 days later, we're down to 18,000 on the Dow. That's historic. So even 0809, it took a year and a half for the Dow to be at 14,000 in October of 09, actually October of 07, March of 09, the Dow's at 6,600. So it was a deeper pullback so far, but the time frame is what makes this unprecedented. So really the question is, and I put this together a few weeks ago, so you can already see some of this is out of date, but the question, in my opinion, is when does demand return? 3 weeks ago, no one had any idea, but we started to see green shoots as far as travel, people getting in their cars, airlines, etc. And we've also seen the concerns and fear dissipate related to COVID. So I do think this is going to be a once-in-a-generation opportunity. I do not know if we're going to test the bottom again. I suspect we will not. That's just my opinion. I think we will look back on this much like March of 09. It's almost unbelievable to think the Dow was at 6,600 back then. I think we'll look back, especially for individual companies, for certain individual companies, and it will boggle our mind that they were cut in half. Whether that's energy companies, but I think this will be an unbelievable opportunity. Buffett also says this: he gets greedy when others are fearful, and fearful when others are greedy, which speaks to the emotional part of this. It's difficult to act when you think it's the end of the world, but logically, remember, historically, we've never seen a time where the market didn't eventually bottom, stabilize, and recover back to where it was, and then exceed that point. And to think about that for just a second, the question is why? Well, when you invest in the market, what you're really doing is you're investing in individual companies, hopefully run by very smart people that are going to improve profits, revenue, dividends over time to their shareholders. And that's ultimately what drives the stock market up or down. So if you relate that to what we just experienced, the reason the market corrected like it did, as quickly as it did, is because the economy was basically shut down. So earnings were going to be affected negatively. And that's why you had such a quick capitulation. Long term, however, this will be a blip on the radar that's important, I think, to remember. So I'll pause. I don't know if there's any questions from that. Otherwise, jump to the next slide and we'll start talking about how we can take advantage of it.
Did you say, I just have a quick question, Trevor, did you use that, you're saying it from a historical perspective, that's the quickest drop of that significance and recovery? Is that ever that we've seen that happen?
Ever, literally ever. We've never seen a 10% pullback as quick as we saw in February, literally in 6, or it may have been 7 days. So that to me is what separates this. I mean, we've certainly seen corrections and bear markets before. In fact, historically, we typically see a 30% pullback on average every 7 years. That's historically based on the numbers. What we haven't seen is that type of volatility that quick. And what's going to be interesting, and this may have already occurred for the most part, is not only did it happen, now I'm talking about the market, so it's important to separate the market from the economy.
Yep.
We may have seen a drop like this and an immediate recovery, not entirely, but a lot of it. And if you look at individual companies, it's even more astounding to think about what transpired for some of the banks. They went down 50, 60%, and they've already recovered 30 or 40% of that. So here's my starting point. Don't forget about the fundamentals. Look, when you talk about building wealth, this is not gambling. We're talking about consistent wealth building over time. And the first thing about building wealth is preserving capital. And so I love this quote. Again, it's from Buffett. He says, look, the first rule of investing is to never lose money. And the second rule is to refer back to point number one. And so, look, we're not talking about picking one individual company or buying a penny stock, especially for those that are on the call that have successful businesses. When you're a business owner, you're used to taking risk, but you typically take risk in your business. And so a lot of mistakes that I saw from business owners that I advised is they were as aggressive in the market. But I think you need to have the right balance there. So investing is very different from speculating. And most importantly, this is the biggest factor that I saw was emotion. Now, I can tell you after 16 years advising people from people right out of college to multi-millionaires, this is the biggest factor. It's the biggest determinant. And the study I always like to quote is a 30-year study in the market. So if you pick any 30 years in the market, so say 1960 to 1990 or 1970 to 2000, right? Any 30-year period, the market has returned approximately 10% annualized. Now, some 30-year periods it's 9%, some it's better, 11%. But overall, if you invested in the S&P 500 index and took a nap, you would have seen approximately 10%. That's a long nap, right? A Rip Van Winkle nap, right? But the average individual investor in that exact time frame saw about 3.5% to 4%, which is awful. Now, what was the difference? Well, the difference is the average individual investor makes decisions a lot of times based on emotion. So it's like clockwork. I used to see it all the time with clients. Once the market corrects based on fear, they believe, even if it's illogical, not based on reason, they would want to sell. And then as it stabilizes and comes back, people get greedy and they want to buy, like clockwork, right? So they're doing the exact wrong thing at the exact wrong time. That is one of the most important things that we did for clients was back them off the ledge and stay focused on the long-term objectives. So a couple of the things here that on how you can take advantage of this, which don't immediately come to mind, is just to start with the basics, to keep doing what you're already doing. So as a business owner, if you have a 401k, you should still be saving into that. You should not have stopped just based on the fact that the market was down. In fact, you should put more in if you can, or certainly max that out in this year, because the market is down, which gives you a great opportunity to pick up the best companies in the world at a discounted value. Don't forget the power of dollar cost averaging, which simply means you invest the same amount every 2 weeks or every month, however you get paid or you pay yourself. And that spreads your risk out. And so as the market is up, you're going to buy less shares of a mutual fund, index fund, or company. And as the market's down, you buy more shares. Over time, that evens out and it truly spreads your risk out. And then the second piece here is a very easy, it's something I recommended to a lot of people during this time, it's to rebalance. And so if you had a portfolio, I'm just going to make this up, that was 50-50, let's say, equities, whether that's in mutual funds, so I'm talking about companies or stocks, and 50% in bonds and cash. Before this happened, you may consider rebalancing your allocation to say 70% equities and 30% bonds and cash. And what you're doing there systematically is you're selling what's high or done well compared to the other part, which would be bonds and cash through this, and then reinvesting at a low point in the equities. And so that's a very easy way to take advantage of this, depending on what your allocation is, but you always want to be thinking differently. Basically, the last point I make on this specific slide is anything, look at it this way, whatever everyone else believes is going to happen or is doing when it comes to investments, you probably don't want to be doing that, and you may want to be doing the opposite. So any questions on that, or just jump to the next slide? Great. So let's talk about how you put your cash to work. I've gotten a lot of questions on this, how you should deploy it. And the first thing I want to just point out here is that this is not your cash reserve. So everyone needs to have a very good cash reserve, especially business owners right now. The future is still somewhat uncertain. You know your business is better than I do. For some of my business owners, we used to advise 1 year's worth of not only business liquidity, but also to have another year's worth of reserves in their personal. I think that depends. The general rule of thumb is 3 to 6 months of expenses. But whatever that is, that stays there. That stays liquid. You're not going to dip into that. What I'm talking about is additional cash above that. And so a couple things you can do here. Number one, you can take the guessing or the timing out of it and, again, go back to dollar cost averaging. So if you have $1 million, instead of trying to time if the market's bottomed or not, you simply say, hey, I'm investing $50,000 a month. And every month, whether the market's up or down, $50,000 is going in, or maybe it's more. I've done it quarterly before with clients, right? And so that way, if the market hasn't bottomed, you're going to be able to see that valuation. And if it has, no problem. You just continue to save in and you take the guessing game out of it. The bottom line when it comes to timing the market is you're not going to get it right. And that's really important to know. No one is going to be able to time it because remember, you have to get two things right. Not only when to get out, but also when to get back in. And there's not a magic bell that goes off that tells everyone, hey, now's the market's bottom, it's time to get back in. Think about the bottom that we just occurred in March. No one would have predicted that because the bottom is the worst. It's the worst news across the board. It's the most fear, it's the most emotion, and the next day it's just a little bit, it's just that much better. So the other thing I would say that I think you can consider is you could also strategically place cash. You could dollar cost average, but then let's say we see another 10% pullback down from here, then you would go ahead and take another 100,000, 250,000 and put it in. And so I've done that with clients too, where whatever, they sell their business, they have $5 million. You know, we're not going to play the guessing game. We invest $2 million right off the bat. Then we're going to dollar cost average a certain amount every month or every quarter. And if the market goes down from here, another 10, 15, 20%. We come off that and we strategically dollar cost average down. Now, the one thing I want to mention here is if it's after-tax dollars, you need to pay attention to liquidity and you need to pay attention to taxes. And so what I mean by that is that you don't want to take money that's after tax and buy a bunch of companies and start becoming a day trader, because if you do that, every time you buy and sell, you will create a taxable consequence. And if it's short term, that gain will be ordinary income and pass through to you. If it's over a year, it will be capital gains, but that's really not how you want to invest there anyways. And then pay attention to liquidity. So what I mean by that is, do you have enough liquidity in the worst case scenario? So if you were to invest in something that's not liquid, you're going to be okay. Now, if you must buy individual names, which I typically don't advocate for unless it's a fun account, especially in times of extreme volatility, right now you need to pay attention, pay close attention to the company's financial strength, balance sheet, their liquidity. Certainly we're in a different world, how we're doing this right now. What is their virtual presence? What I like to do is to think out as well. And so as soon as this COVID stuff hit, how are things going to change? And based on, if you go back, I challenge everyone to look at this, go look at where Zoom was at the beginning of this year, where it's at now from a stock perspective. It's more than double. So if I can go back in time, I got some of these right, but Zoom, telemedicine, of course, Amazon, Apple, Walmart's done really well. Domino's Pizza's done really well, right? Because people still have to eat. So those might be some interesting things. The NASDAQ, by the way, if you look at it, went over 10,000 and is positive year to date compared to, say, the Dow or the S&P 500, which is still negative. I got this question the last time I did this on asset classes. I'd be careful here, because if you're trying to overweight asset classes, which is large cap, mid cap, small cap, international, emerging markets, real estate, there's a good chance you're going to get it wrong. And all that really is you're timing the market. Now, if you had a diversified portfolio and you wanted to overweight slightly, I think that can make some sense. But here's my thoughts. Typically, small cap, small companies will lead sectors out of a recession. So again, if you go back and you look at the index in March at the bottom, small cap has outperformed large cap. That's pretty normal if you look back at every recession. We'll see if that holds. Large cap and growth has been the clear winner, not just out of this, but over the last 5 years. So growth would be companies that are more focused on growing their top line. Value, which is the other side of that, are typically companies that are more mature. They're paying a larger dividend. But here's the thing, nothing remains the same. There will be rotation eventually, not just out of large cap and growth, but also international and bonds have been terrible. So a lot of people think right now that international, the US is going to outperform the international for as far as the eye can see. That may happen, but I can tell you that anytime everyone thinks something, typically that does not happen, right? And so there will be rotation, just be careful. The answer here, in my opinion, is what I put there at the end. Stay diversified. Again, we're not swinging for the fences. Many people on this call, if you're a business owner, are already very successful. So what I used to tell people, and when I was advising my clients that were already financially independent or had a very successful business, is we are not trying to generate 20% annualized by taking crazy risk. I'd much rather you come back to me 20 years from now and say, hey, we averaged 8% with an appropriate risk tolerance, as opposed to, holy cow, we struck out, and your 5 million or whatever has now been cut in half. That is, to me, that's gambling. Slow and steady wins the race, and being diversified is a key component of that. That quote down there I really like, and that's basically what diversification is. You're never going to make a killing, but you're never going to get killed. So questions on that?
I have a question on your last slide a little bit.
Okay.
How often do you advocate stop loss sell orders? So part of Buffett's quote was not to lose the money. Obviously, during times like this, the stocks that you own will go down and then come back up again. Do you implement any trailing stops when you do investments with your clients, or do you advocate for that? Or if it's a good company, kind of buy and hold and weather that storm?
Yeah, that's a great question. So I've done that in certain situations. So a couple things. Number one, let me quote Buffett again. When he was asked what is his favorite time frame to own a company, his answer was forever. So just to give you a perspective on the oracle. Here's where I would implement stop loss when a lot of your wealth is tied up in a single company. So, a lot of clients that I worked with are down here in the energy sector, so stock options. I think it's appropriate to manage risk there. And sometimes with those clients, they had an emotional attachment. So I would say, well, your basis is here. Let's at least put a stop there so we're not taking an absurd amount of risk when it comes to their situation. The other thing I would say is that if you have an investment that is done unbelievably well, you invested in Apple, when it was $50 a share. I think stop losses can make sense there as you diversify out of that position. Meaning if it's whatever it is now, 200, 300, you may put a stop loss in it at a specific point for a certain amount of that. To me, again, it goes back to risk. But I think for the most part, I wouldn't put stop losses in, because what you're doing is if there's a move, it could get you out of that company, and then you miss the resulting recovery. The way I look at it, to answer your question ultimately, is do I want to own this company long term? And if I do, I'm okay with short term ups and downs and volatility based on what I know about it and believe where they're going to head.
Thank you.
Yeah. So next slide is real estate. I've gotten a lot of questions about this. This is the space that I'm in now, specifically apartments and multifamily. I could talk for hours about this space and why I like it so much. But I think in real estate, it depends on which sector. And we've seen this like you wouldn't believe coming out of COVID, or still in it, really. Look at hospitality. You look at retail. Those have been absolutely destroyed, especially hospitality. I think it's improved significantly, but a month ago, the average occupancy in hotels was something like 10%. So you can imagine being in that investment or being an owner right now, what that would feel like, right? With that being said, residential and multifamily have done unbelievably well. And so if you think about that logically, why? Well, people will always need a place to live. Both individual apartment complexes that we own and are invested in are 100% occupied right now. And I think the reason for that is because, people are not, when there's fear and emotion, people start to downsize, people sit on their wallets, there's inactivity. The thing I like about it is I don't think when it comes to residential and multifamily, you have as much risk as far as being disrupted from a technological standpoint. I think people are always going to need a place to live. The thing I would say here also to everyone that's listening, scale matters. So if you're doing a duplex or a fourplex or a single family home, I'm not a fan of those, because if you have vacancy for even a month, maybe 2 months, or your duplex one side isn't rented out, you're in the red. As opposed to a 100 unit or a 200 unit apartment complex, I can have 8%, 10%, even 12% vacancy, and I'm still profitable and cash flowing. So I look at cash flow. Location is critical. I like certain emerging metro areas. I'm in Houston, but I don't invest there. I'm actually looking at Tulsa and Northwest Arkansas, which may sound a little strange, but look at the numbers. The amount of growth that they're seeing there is phenomenal. And then when it comes to whether it's single family, really anything, hospitality, retail, your management may be the most important factor. And so people will find out that property management it can be a big issue, right? So you got to find the right people. Now, let's talk about how you invest in real estate. So a lot of people may be familiar with investing in real estate within their 401k. What you're doing is you're investing in a real estate mutual fund, index fund. Some people have probably heard of a REIT, which stands for a real estate investment trust. The question I would have for you here is, what do you really own? Do you actually own the real estate? Or is it a piece of paper that's traded on a stock exchange? There's a big difference. And that's why I'm a big fan of raising capital now and helping people invest into the actual asset itself. The reason for that, and it's very, very different, because taxes is probably the biggest, which I'm going to talk about. The other thing I'll say here is be careful about syndications. Those have become more popular over the few years here. But what that comes down to is, who are you? It's almost more important than the asset itself is the operator. Who are you investing with? Do they know what they're doing? Have they thought through risk? Worst case scenario, where's the asset? What's their plan, et cetera? So a little bit, I think I need to speed up a little bit here, but the one thing I want to talk about here for everyone that's on the call is real estate is an investment that offers a combination of advantages that no other investment can. Remember, this is coming from a former wealth management stock portfolio guy, okay? So real estate can offer everything from cash flow, consistent monthly cash flow, leverage, which is a huge deal right now based on where rates and debt is, certainly appreciation over time. One of the biggest things I like is control. And this used to drive me crazy in working with clients, is you don't really have control over what's going on with your investment portfolio. If you think about it, if you invest in a 200-unit apartment complex, there's all sorts of different things you can do to force appreciation, from making actual improvements to getting better on the expense line, which is a very easy thing to force value appreciation. But the biggest to me is the tax advantage. And this happened with the new Trump tax laws, I think in 2017, is you're now allowed to take all depreciation 100% upfront in year one. And that is a huge deal, because what you can do now, let me see if I can simplify this, is you can take that, if all qualifications are met, directly against your earned income. So I had a client, they make well over $1 million a year. He works, his wife does not. And we advised him to take his wife off payroll immediately, and for her to meet the real estate designation, to meet that designation. It's pretty simple. You need to commit 15 hours a week to real estate. You don't have to have your license. But because she was able to meet that designation, they then invested in a fairly large piece of commercial real estate. They were able to offset all 7 figures of that income through bonus depreciation, thereby saving them something like $300,000 in taxes last year. That continues for a few more years, and then it gets phased out. If we have a change politically, that may get phased out immediately. I would encourage everyone to look into that that's on this call. Massive tax advantages, not to mention finding an asset that can diversify you out of the traditional stock market portfolio. And we just don't know how long that's going to last. But I'm a big advocate of that. So I hit everyone with a lot there. Obviously, make sure your CPA and tax attorney are involved. But there's a little bit more to it, but that's the general overview. So any questions? Great. So I'm going to speed up. I heard a lot about this probably a couple months ago, and that was the energy sector. If you remember, we saw some unprecedented things happen to futures contracts where it actually went negative. A lot of people didn't even know that it could go negative. So there was just no demand, as you can imagine, when the economy was shut down, that they didn't have anywhere to store it. And so they were actually paying people to store. And it was just a crazy time. My advice here is now, again, is not the time to speculate. Do not invest in leveraged exchange traded funds, which is what the ETF stands for. There's funds out there that will go 2x, 3x, allegedly, and are tied back to crude oil. Doesn't work exactly like that. You can get into a lot of trouble by speculating. What I am a fan of in the energy sector is buying or investing in great companies that you know are going to be here, that have been hit very, very hard, that still are paying dividends. And so in essence, you get paid to wait. So a good example might be Chevron, BP, Exxon. Dividend yields at the bottom were close to 12, 13% in some cases. You literally could have just owned that company and seen 8, 9, 10% through the dividend and waited for the stock price to eventually return. I think that's a great strategy as long as you're patient. Again, my question here is demand. When will demand return? You know, is it going to be a V-shaped recovery? Is it going to be a U? We really don't know. No one does. Certainly with COVID, who knows? Is that going to make another appearance? What we do know is that eventually this is going to pass and people are going to start flying again and driving if they already have it. So that's my 2 cents on energy. I do think there's some significant opportunity there in those companies. Some of it's already happened, and some companies that aren't even really connected to the price of oil have been hurt significantly as well. A good example might be Phillips 66, which is more on the refining side, but they still were absolutely penalized. I think it went from 120 down to something like $45. It's now back at 80 or 85. So you can see the type of opportunity that was there and still might be there. So I'll pause again for questions, and then I'll wrap up here on what I think is maybe the most important slide in the deck. Great. So next slide is what I'm titling, to get everyone's attention, the most powerful investment concept ever. And look, this is true. It's absolutely true, and that is tax-free compounded wealth. And the important point that I'll make here is that taxes are the enemy. That's about as direct as I can say it. They will take a significant amount of your wealth at some point, right? And so the tax-free component here is that there are ways to get your assets into certain buckets that will allow it to never be taxed ever again in compound tax-free. So we'll start from simple and then we'll go to complex. Number one, Roth IRA. I'm sure everyone's heard about that. Do you have a Roth IRA? And if not, why not? Now, most people may immediately say, hey, I make too much money. We cannot do a Roth IRA. But there are ways that we can get around that. Remember that we're talking about multi-generational wealth here, because the Roth, once it goes in after tax, is never, ever taxed again, ever. So that's the type of opportunity. If you do some quick math, you can see how this would compound, not just over 10, 20, 50 years, but what about 100 years? So one of the easiest strategies for business owners to do is to put your kids on the payroll. It's a tax benefit for the business owner, and you can pay them. You need to get the CPA involved here, but you can pay them up to, I think it's 12 or 14,000 in this year. Double check me on that. But you can immediately pay them if they meet those qualifications. It has to be reasonable and all that stuff. And one of the things you could do is max fund a Roth IRA for them each year. And do that over the next 18 years at 8%. It would boggle your mind how much they would have, let's say at 18 or 22 or whenever you stop doing it. If you were able to convince them to take it over at 22, they would have an astronomical amount, something like $6 million in a tax-free position by the time they got to 60 at retirement. The other thing you can do is you can fund a 529. And remember, 529s are education specific, but you can use that for secondary education now. Doesn't have to just be for college. So I would recommend everybody do that for their kids. Again, involve the CPA. Now, there's lots of opportunity when it comes to converting money into a tax-free position. So let me try to set this up as best I can. A lot of people will have a lower taxable income in 2020 because it hasn't been a good year because of COVID. And so because your taxable income is going to be less, this would be a fantastic year to convert money from a traditional IRA or your 401k if you can access it and have that ability. So you're going from a pre-tax position, converting it to an after-tax or tax-free position. Now, of course, you have to pay taxes on those dollars, but what better year to do it than in a year where you're in a lower tax bracket because you have less taxable income. And remember, don't forget, we're in a very, very favorable tax position still. Tax rates are some of the lowest they've been historically. Don't forget, wasn't that long ago, I think it was in Reagan's administration, where the highest tax bracket was 50%. And I can make a pretty compelling case based on what we're doing and the deficit that taxes are probably going to be higher in the future, not lower. So if you're ever going to do it, now's the time to do it. Take the pain now. And my final point here is that the market's still down. It may not be 20%. That was the last time I did this presentation, but it's still below where it was. And so if you can get that into a tax-free position, you'd rather have the growth in a tax-free position as opposed to a taxable position, because eventually these dollars over here, when you take them out, will be taxable. So I think it makes a ton of sense to evaluate that and consider converting to make sure that those dollars are never taxed again. So a couple other things here. Do you have an old 401k that's just sitting out there? So you might be able to roll that to an IRA and take advantage of this strategy. Sometimes within your current 401k, there's opportunity to put dollars in pre-tax, after-tax, and Roth. So you may consider how you're saving in. Personally, I always saved everything into a Roth just because I understand how powerful it is to have flexibility in retirement and to access money tax-free. There are many more strategies here with entities I won't get into. Just know that that's a powerful concept when it comes to tax-free wealth accumulation over time. And of course, you need to get the appropriate counsel. So questions on that I can answer?
Trevor, can you just clarify what you mean by entities? In that
yeah, and Jason, you may comment here, but in our last call, we talked a little bit about setting up a trust or having a trust already set up, different types of LLCs where if you're going to sell, you can convert those distributions or convert that into a tax-free bucket and then start to take those dividends completely tax-free moving forward. That's a very general overview. That's what I meant by entities and advanced strategies. I don't know if you have anything, Jason.
No, you answered it. That's really the discussion. It can get pretty complicated, but it's one of those things. Sitting down and developing a strategy makes sense, certainly at that point.
Yeah. So I threw a lot at everyone there. I'd love to answer questions, open it up. While we do that, I would just go to the last page if you could real quick. That has my information for everyone. I guess just regard half of the screen. But there is my website, email, and cell phone. Love to talk to people more about that strategy, certainly real estate and what we're doing. You can go to ShakibaCapital.com. There's a lot more information and videos. You can see some of our current investments. And we're certainly looking to raise capital and tackle some fairly big projects here at the second half of 2020. So any other questions or thoughts that I can comment on?
Yeah, I had a question. Oh, sorry, Jason, go ahead.
No, I was going to ask about the projects that you are developing. And as you get into multifamily investment, are you guys typically looking at taking over a facility, a building, and maximizing the operating efficiency, or are you looking at building new? What's your strategy there? How do you typically get into that market?
Yeah, so the two we've done so far have already been built and occupied, and we were able to go in and really become more efficient on our management expenses, and then we're looking to add value and drive rents. And the thing that I love about multifamily beyond the tax advantages is that it is a math calculation. So if you think about building a single family home, well, you're kind of at the mercy of the market. But when it comes to multifamily, it's based on your net operating income, your cap rate, math calculation, and that determines the value. So in our most recent project, we were able through the expenses right out of the gate to be able to increase our net operating income. And so we saw almost immediately after the first 6 months, a valuation go from 5.75 million close to 8 or 8.5 million. And that's what I love about it is there's inefficiencies in that arena, and you've got control again. And then final piece would be that tax benefit of depreciation would flow through to the owner and the investors that you can take depending on your structure, and basically have distributions and not be taxed on it. Now, the other piece is that I am looking right now, hopefully soon, at going under contract at a new build where I think there's significant opportunity based on the market and the growth. So I think it just depends on where value is and what returns are. But for those projects, we're looking for cash on cash returns of approximately 8% and total annualized returns of 20%. Because that opportunity is there. Now the downside is it will be illiquid, and so that's something that you have to evaluate, and then of course there's risk involved.
Do you target opportunity zones or finding ways to creatively to maximize tax benefits during those process, the research process, or how do you determine the best?
Yeah. Well, I'm looking at another project that is an opportunity zone. And for those that don't know, that's a new law that came into place that if you start a business or you're able to improve a piece of land, if you hold it for 10 years or more, all capital gain tax goes away, which is just, again, a huge incentive. Meaning, if you had $2 million capital gain and you invested into a project like this, and you hold it, not only did you invest hopefully in a great asset that pays you monthly with cash flow and is going to appreciate, but that $2 million capital gain goes away. So I'm looking at that to answer that question, but there's massive tax benefits in assets that aren't in opportunity zones, because what you would do is you would do something called a cost segregation study, which allows you to determine what you can depreciate in year one. So, it used to, depending on the asset, it used to be over a certain time, 15 or 27.5 years. You can almost take all of it up front in year one and offset passive income or ordinary income if you meet the qualifications.
That's great.
So Trevor, you're looking, and when you do these types of investments, you're pulling in other investors and doing it are you personally doing these investments, or are you pulling people in to do those with you?
It's both. So the first two we did ourselves. With the second one, there was a couple small investors, but moving forward, we're going to raise capital. I need to do it because I sold my business, and I need the tax strategy as well. But probably everyone moving forward will at least participate along with our foundation, at least 10%, if not more. So we're looking to do both and take advantage of all the things that we just talked about.
And Trevor, to what level, what type of investment are you typically looking at for those projects?
Yeah, that's a great question, because on this type of investment, you must be an accredited investor. And so that's defined as someone that makes, I don't have it right in front of me, but someone that makes $250,000 or more or has $1 million net worth, not including their house. So that's number one. Those are the only folks that are allowed to participate, at least right now. And I'm probably looking at a minimum of 100,000, but we'll see. So I see some additional questions there. I don't know. Do you anyone want to target?
Yeah, I was interested in that first one, that kind of whole Roth account 529. I've been really spinning on that. That's a really interesting one for me. So I started paying, for example, my new CPA had me start paying my kids $12,000 each a year this year. If I can't contribute to a Roth, I've traditionally put in their 529 that they, just one of them's on. But the Roth piece is interesting. If I can't do that, can I create a Roth on their behalf, or how do I work around leveraging this year to invest in a Roth, particularly the multi-generation component? Like, what can I do in that regard?
Yeah, so I'll tell you exactly what we do, right? Yes, the answer is yes, you can create a Roth for them. So we just split it right down the middle this year, because I think the maximum Roth contribution was 6. And then the rest of it went into their 529. And so that's what I recommend each and every year. Again, if you do the quick, I'm going to do this. In fact, we'll do it live. That's always dangerous. But if you do 6,000 a year for 18 years at 8%, they would have 225,000 at 18 in a tax-free position. And where it gets unbelievable is if you do 6,000 a year, and let's say they're responsible and they take it over eventually, or maybe you do it until they take it over. So you did it for 60 years and they did it with you. That's 7.5 million tax-free, 6,000 a year, 8%, 60 years. That's how you build multi-generational, indestructible wealth and think differently when it comes to taxes.
Thank you. That's great.
Yeah, and for those that make too much money, that's where I think having a CFP, having the right team, certified financial planner, CPA, estate planning attorney, there are many unique strategies that we can think through to get you a Roth IRA, as far as converting, or do you have the right 401k set up where because remember, the 401k doesn't have income limitations. So you can have a Roth 401k, and you could say then up to whatever the limit is this year, 18, 20, whatever, the 1,000. And so that's how we got around it for a lot of our business owners is, yeah, you can't do a Roth IRA unless we convert money from a pre-tax IRA to a Roth, but we could do a 401k. You could even do a combination, meaning you could do 8% pre-tax, 8% Roth.
Trevor, is there any Roth-like vehicle that's related to a SEP for sole proprietors or small business owners?
Yeah, I mean, you put me on the spot there a little bit. I think a SEP IRA, I don't know that you can do a Roth SEP IRA. I don't know if it's all pre-tax. There is some validity to looking at life insurance from a tax-free component. I'd say, that needs to be a specific situation, but we've done that for business owners, where what I'm talking about is there's an investment component of a life insurance. So a universal, variable universal, or indexed universal life. You could do something like that as well. But normally we don't get to that point unless there's a big life insurance need or an estate planning need, or we've maxed everything else out, right? But yeah, I just look, it's great to get that pre-tax benefit today. But what I try to advise clients on a lot is don't just think about today, because if you retire and you've got $5, $6, $7, $10 million in a taxable position, that is like a bomb that's going to go off eventually when you get to the required minimum distribution age, which is 70 plus. then you completely lose control of your taxes. And you could end up paying more in taxes depending on what value that is, because you may not need all that money. So what the IRS is saying then at 72 is, hey, we haven't got our tax dollars yet. And so here's a formula that's going to force you to start taking out X amount of dollars each year, and it only goes up each year. And so you don't want to be in that position either. And especially with where taxes are now, which is very favorable in my opinion. Look, if we have a change in the president, taxes are going up. I think everybody would agree with that, no matter where you come out politically. So that's why I'm a huge advocate of looking at that now. You don't have to do it all now. If you have $2 million in an IRA, yeah, probably don't convert $2 million, but maybe there's a way each year you can kind of dollar cost average with the help of a CPA into a Roth conversion. But I've seen huge problems with, for example, executives down here that worked at Shell or Exxon for 40 years. They'd have a huge pension and IRA. And every year they would complain about being in the top tax bracket because they were being forced to take money out of their IRA based on required minimum distributions.
Good. All right, I think we've got time for maybe one more.
Yeah, you tackled a bunch of these. Is there anything on here that stands out?
Yeah, let me talk a little bit about how you would choose equities, funds, indexes. And the first thing I would say is, for most people, I'm not an advocate of doing it yourself. I think you need to hire experts in that category because they will be worth their weight in gold. I think most people would agree with that, especially small business owners when it comes to legal counsel and taxes. Same thing goes for investments though, right? But the thing to pay attention to when it comes to investments, mutual funds, index funds, to me, the first thing I look at is expenses, okay? I think owning the market through Vanguard Total Market Index or Small Cap Index is very important, because if you're paying a fund manager 1% or more and they're not delivering out performance, what is the point of that? Moreover, if you did a quick calculation and you would have gotten 9% instead of 8% over 30 years, you're talking about hundreds of thousands of dollars. So I pay really close attention to expenses. I pay really close attention to what they're actually invested in. Not all funds and indexes are created equally. If you're looking for an ETF, for example, an exchange traded fund, and you wanted it to be in the energy sector, well, look at the underlying companies they own. What's the actual strategy? What is the cost? So I think that's really important, especially in 401ks, because you're somewhat limited usually. If you're a business owner and you have the opportunity to, change or have any 401k, you want a 401k that has really good options in every asset class, some indexed, some actively managed, but ones that have shown a great track record and have a good, appropriate, competitive expense ratio. So that'd be my thoughts on that.
Well, Trevor, I was just chatted with Jason directly and said I could do this all day long, but I love this. But it is, we're right in an hour. That was incredible. I learned a lot. I have about 4 emails to send out to my CPA, to my wealth manager, to my, all those people with questions and meetings that are going to be coming up based on that chat. So thank you. Brett, would you mind just sharing one more time the contact information for Trevor while we wrap? And just to make sure that we wrap up the video with that. And Trevor, again, thank you very much for taking the time and joining. Left side of the screen there, Shakiba Capital. You've got an email, phone number, all that good stuff, website. And I really appreciate you taking the time. It's been very valuable.
Yeah, you bet. Love to chat with anyone. Just shoot me an email or text or call me there. And one other quick thing is, I do have a newsletter I send out every couple of weeks. I try to really add value to help people think differently about building wealth. So if you'd like to be on that, shoot me an email and I can put you on that. And that also will have new opportunities for Shakiba Capital that we're about to bring to market. But really appreciate the invite, everyone.
You bet.
Appreciate it.
Appreciate it.
Thanks
Thank
so
you.
much.
All right.
Thank you.
Great day.
Thanks.